Good morning, everyone. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer for Cantor Fitzgerald Managed ETF Portfolios. This is my weekly macroeconomic and market commentary for the week beginning today, April 14th, 2027. If I have anything to say intra-week, it'll be posted on LinkedIn or Twitter. LinkedIn handle is Herb Morgan. The X, or formerly Twitter, handle is @Herb W. Morgan. Everything you see and or hear is created by me, and it is designed for use by both financial advisors and individual investors. Regardless of who's using it, everyone is expected to make their own investment decisions. Nothing contained in the presentation should be treated as investment advice, tax advice, or the recommendation for the purchase or sale of any securities. The views expressed are mine and mine alone, do not necessarily represent the views of CFIA's parent, affiliates, or other portfolio managers here at the firm. Well, we had a great week last week. Equity markets rebounded sharply as it seemed like the brakes were tapped on some of the implementation of some of the tariff measures. Markets took that as a positive, also coming off a bit of an oversold position. The S&P was up almost 6% on the week, but as you can see, the year-to-date numbers still firmly in the red, just barely positive with developed international, everything else negative on the year. Interest rates spiked up, so this was interesting. So stocks, okay, great, stocks were rallying, bonds sold off a little bit, but it was a big sell-off, and yields were really spiking higher. And I think that fact is more worrisome than any other to policymakers today and those trying to implement this new agenda around tariffs and non-tariff trade barriers. And you saw yields spike higher on safe treasuries. This is normally at a time these catch bids, right? This is the flight to quality. And we had the 20-plus year Treasury Index down 6.5% on the week. The aggregate bond index, it brought the aggregate bond index down about 2.5% on the week. Let's move into the economic data reported last week. We had a negative surprise on consumer credit. February consumer credit actually fell $800 million, and the estimate was that it would increase $15 billion. Revolving credit was up just a little bit, but what it tells us is that consumers just weren't feeling the love or really the confidence that's required to put themselves in debt, whether it's for a new washer and dryer or clothing or cars or whatever. But they decided not to take on consumer debt in the month of February, citing obviously unease around things like inflation, tariffs, tax policy, etc. To back that up, we got the consumer sentiment report from the University of Michigan. Fell to 50.8 from 57, well below the estimate. And look at over here on the right, just a sharp drop off in consumer sentiment. To get numbers these low, you actually have to go back to the period right before sort of the reopening of COVID. We're going back here to about 3 years ago, spring of 2022. Current conditions fell significantly. Expectations fell very significantly. So the consumer is getting worried, and if the consumer gets worried, they could potentially pull back on spending. You pull back on spending, you pull back on earnings. And what about businesses? Small business optimism reported for the month of February. Remember the massive spike, the biggest spike ever post-election. It came post-election, was the biggest spike ever on the prospects for pro-growth economic policy. This index fell from 100.7 to 97.4. That was below estimates. But why did people feel less confident? The businesses that responded, they said, well, inflation's got us continuously worried. Labor quality is horrible. The available labor quality, labor market being tight. And we have a lot of uncertainty around taxes. We don't know what parts of the Tax Cut and Jobs Act 2017 are going to be extended. Interestingly, if you look at the inflation issue, we got some good data last week, which I'm about to tell you about. And the taxes, we had the House passed the extension of the Tax Cut and Jobs Act 2017 expiring provisions last week. We got our regular Thursday initial claims for unemployment. They came in at 223, right in line with estimates. That's a very low number. Labor market is very tight, which goes back to the prior slide. University of Michigan, the National Federation of Independent Businesses responded saying they're worried about quality of labor. So the labor that's left, in other words, that's still not employed, is not as of the quality perhaps they're looking for, or the skill set perhaps that they are looking for. Continuing claims came in at 1.85. So here's the good news on last week. Inflation numbers surprised significantly positively, both CPI and PPI. The CPI for the month of March was estimated to go up 0.1%. It actually went down. The year-over-year number is 2.4. The estimate was 2.5. That's a beat. More importantly, core CPI was expected to be up 0.3. It was only up 0.1. The year-over-year was expected to be 3. It came in at 2.8. And where I had been saying the downward trend had ended, it looks like maybe, just maybe, the next couple of months will tell us, but maybe that downward trend is starting to resume. And on the other hand, on PPI for the month of March, now with PPI, not only had I said it stopped going down, it had been going up. And when PPI goes up, that usually leads to CPI going up. March PPI actually fell 0.4%. Estimate was for up 2. That's a huge beat. And year over year, 2.7 versus an estimate of 3.3. Also a huge beat. More importantly, again, core fell instead of the rising, which was the estimate. Year over year, still above Fed inflation expectations, but 3.3 is better than 3.6. So these are beats. These are exciting. And it kind of moves us on to talk about, well, what's happening with the equity markets? They went up last week. Great. After a lot of down weeks from Tariff Liberation Day, etc. I expect more of this, more vol. The VIX has not settled back down to that sub 20 level. That's the volatility index. We are always just a tweet or a press release or a comment away from big moves up or down, and I think we're going to have to live with that for a little while. That's just part of investing. It's not for me to like or dislike. It's for me to manage around, and we're fully prepared to do that. We've done that before. We did that in 2020, did it in 2018 with the tariff tantrums back then. We did this in obviously 2008. So we've been here, done that, bought the t-shirt. But this is a chart of the forward PE multiple of the S&P 500. When the market was at an all-time high back in February, we were between 22 and 23 times forward earnings. When the market sold off aggressively after the Tariff Liberation Day announcement, the forward earnings multiple got down to 18, market rallying back up. We're at 19. So stocks aren't overly expensive, but they're certainly not cheap. They're just moderately expensive, I would say, still. And the question becomes, okay, but now we're in earnings season. Earnings for the large part have been good. But companies with less certainty about their future, which is where we are right now, because we don't know exactly what the tariff situation will be, the international trade situation will be. If they have more uncertainty, they will probably generally guide the earnings lower. If they guide the earnings lower, the analysts take their estimates down, and then that PE then certainly goes up because it's a higher current. If the P stays the same and the E goes down, you have a higher PE. On the other hand, the earnings could continue to surprise to the upside. We could get through this. We start to get some clarity. We got the Tax Cut and Jobs Act expiration taken care of or close to being taken care of. All of this. So there's just sort of this leverage into the market. It could go up. It could go down. And it's all based on short-term developments at this point. The one thing we do know that the forward PE is the forward 4 quarters, one of which is being reported now. That will drop off. That was in the $64, $63 range, and that'll be replaced with the first quarter of 26, which is in the $70 plus range. So that, of course, will bring the PE down unless those estimates get changed. These are forward earnings estimates. They are subject to change and subject to get beat or subject to be have disappointing results. Okay, in terms of data this week, nothing really big today. We had some Fed inflation expectations today, but that's really it. Tuesday, we've got New York State manufacturing expected to be down 15. Import and export prices expected to be flat. Okay, that would be good news. Retail sales, industrial production, and utilization business inventories, housing market expected to still be just miserable for home builders. Weekly claims for unemployment, low, 225. Housing starts permits, Philly Fed survey, and then Friday, nothing scheduled. Bottom line is I don't think any of these metrics, these data points, are going to have much of an impact this week. I think this week the market is going to move based on earnings guidance, and that all takes a second chair to the developments on the international trade front as we get announcements, tweets, maybe a deal with a big trading partner, or maybe things heat up and get worse temporarily with China, etc. That's what's going to continue to move the markets. I would not advise anybody to try to trade around that. That's going to be very difficult. Stay the course, be invested, use the declines to your advantage, make the assumption that declines are ultimately temporary. Okay, don't forget this is available as an audio podcast pretty much everywhere, but the best place to catch us is on YouTube. Slaying Bulls and Bears is the name of the YouTube broadcast. We like to make the complex and complicated simple and sensical. Thank you. I will be back to you 1 week from today.